Thanks everyone for joining today's webinar with the Temple Health and Bioscience District. Today we're happy to have Brian Toglia here in person with us, and he's going to be talking about the top instances when insurance protection becomes most important and how to develop a strong insurance plan to set your company up for success when it's time to hit the market. Brian is President and CEO of Galiot Insurance Services, a boutique insurance firm that serves the life science industry. They provide proactive, tailored risk management and insurance solutions to companies of all sizes, from preclinical to multinational. Before I hand it over to Brian, I just want to remind everyone, as always, you're more than welcome to ask questions anytime throughout the presentation. You have a little questions tab on your control panel over there, so feel free to drop them in and we will address them all at the very end. And also, if you want to go back and rewatch this presentation, you're able to do that. This will be live recorded on our YouTube channel. And also, Brian's presentation is included in the handout section of your control panel, so you're welcome to go in there and download it and keep it for later. But with all that being said, I think you're good to go, so take it away.
All right, thanks. And everyone can see my slides?
Yep, you're good to go.
Great. Well, good afternoon or good morning if you're in Mountain Standard or Pacific Coast time. I'm Brian Toglia, President and CEO of Galiot Insurance. I thank Tammy and Kelsey and their team at Temple Health and Bioscience District for having me and recognizing the importance of this topic. This is a program I put together several years ago as I realized that particularly first-time entrepreneurs really didn't have a lot of experience in purchasing insurance, particularly on the commercial business side. Most of their experience had been through the purchase of personal insurance products, home and auto, and as we know, that's, you watch any TV, there's a lot of, it's all about price typically, and you see the Farmers and Geico's and State Farms of the world. So purchasing insurance for a life science startup is significantly different. It's not always price driven, although the goal is to keep the price down as much as possible, but focusing on protection and making sure that an unexpected event doesn't derail your technology is really important.
Yeah, your screen's not showing for some reason. Here we go. Now we're good.
Okay. And you can hear me all right?
Mm-hmm.
Okay.
Yep, you're good.
Great. So I've given this presentation to various incubators throughout the country, and I'm going to go ahead and jump in. And we called it says Insurance 101 for Startups. I've kind of changed the name from Cradle to Exit, Insurance 101 for life science companies. And so we're going to kind of work through various stages of development and just help you understand what you're going to encounter and what that might mean from an insurance standpoint. So I go to a lot of events throughout the country, life science conferences. And a lot of times, people will look at me like, well, what are you doing here? What's so important about insurance? And there's a lot of entrepreneurs that have, come up with a great idea or technology out of a medical institution or academic institution. And they're kind of given a priority list, which I put up here on the screen. So yeah, most have attorneys, potentially two, one to help determine what the correct entity is to be formed, and one is to protect your IP, which is arguably your largest asset. Typically they'll introduce you to an accountant who will be able to kind of go hand in hand with the formation of the entity and how that might work. And also, of course, when you're first starting out, you're looking for your funding and heavily in the non-dilutive space if you can. So you're looking at grants, SBIR, NIH, things like that. And also, start with friends and family and angel investment. So what happens as you get through this now and you're becoming a real company, you might now look to go into some kind of commercial lease space or an incubator, and that's when you might encounter your first exposure to insurance. And that's kind of when panic sets in, because people get that lease agreement and they don't know what to do or where to go for that. And so I'm going to kind of start there, if you will. So this is just kind of an overview of the 6 areas that I've identified when the need for insurance during the life cycle of your company might come up. And so the first 2 typically will be at the same time or go hand in hand. But I will start, you'll see on the next page, with required by contract. But these are the 6 areas. So required by law, required by contract, required to receive funding, transferring catastrophic risk, addressing operationally specific risk, and then everyone's ultimate goal is some kind of M&A exit strategy as you get through all of this. And so there's some insurance implications there as well. So I'm going to start with required by contract. And I just kind of given an example where, okay, you've formed your entity and now you're looking to go into the lab or get some commercial space. And so first of all, insurance in and of itself is a legal contract that you enter into. And what people don't typically realize is it's probably the most complex legal contract you'll ever enter into without consulting an attorney. Now, that's not to say that there aren't entrepreneurs that do have their attorneys take a look at it, but typically when you're buying an insurance policy, you're not sitting down with your attorney to go through line item by line item. And that's so the delivery method is through insurance brokers typically that will help kind of guide the purchasing process. So the first one will be is you'll see some kind of commercial real estate lease or an incubator client agreement. And a lot of times the number 1 provision for insurance you're going to see in there is commercial general liability. And that's going to be slip and fall coverage. You're not going to have a product at this time. You're typically in the R&D phase. So no need to purchase product liability insurance at this time. And that is something that's a little different about, say, if you're a retail operation versus a preclinical or R&D stage company, is that commercial general liability and product liability are not purchased together. They are purchased on separate policies in the life science world. So what you're going to see in these contracts is you'll see all kinds of language around the landlord will be asking for additional insured status, which what that means is if someone is visiting you at the facility and they slip and fall and they decide to sue, they're going to name you as the company that they were there to visit, plus they're going to try to drag in the landlord. And so additional insured status just means that the landlord has first dollar protection on you as the tenant's policy because related to your operation, because that person was there for you, not necessarily for the landlord. There might be wording around what we call primary and non-contributory language. And all that means is that your insurance is always going to be primary over the landlord's policy. Their policy is not going to contribute until all of your policy limits have been exhausted. You may see some waiver of subrogation language within the contract. And all that means if it's somehow determined during the process of this lawsuit that the landlord was somehow liable for that slip and fall, say they failed to repair the sidewalk and that ended up actually causing the injury, that your insurance company can't go back against the landlord. That's what the waiver of subrogation does in that instance. Then another common you'll also see is 30-day notice of cancellation as well. And that just means that if your policy is going to go into cancellation or not renew, the landlord would like notification of that. So when you look at all this, you might be thinking, man, this is going to be really expensive. But how these policies are set up for these commercial general liability, typically just slip and fall at this stage. And a lot of these provisions are either automatically included within the policy for no additional charge. They're built in, or there's a small additional fee to add all these in there. Other common provisions you might see is they might ask for additional umbrella liability coverage, which is just excess liability in addition to the commercial general liability. They might ask for hired and non-owned auto liability. You're driving onto the premise on and off, so they want to make sure that if you strike someone in the parking lot or run into the building, that you do have some kind of liability protection related to that exposure. If you have employees, they're going to require you to carry workers' comp. And so I'll just give you a real life example. I deal a lot with the J-Labs facility down in Houston, and they have very strict requirements. And basically, you do not get your key code to access the facility until you present your insurance certificate. So they are very strict about this, and you have to meet all their guidelines. And all these various areas that I just mentioned, commercial general liability, umbrella, hired non-owned auto, work comp, are all on their policy. In addition, they also require you to make sure that you're carrying coverage on your own property, which I'm going to get into a little bit later here on contracts as well. But the landlord does not want to be responsible for damage to your property on their site. Another area where you might see a required by contract is you've developed this technology at an academic institution or medical institution, and now you're negotiating a licensing agreement. And all these facilities have their stock language that their attorneys have put together as far as what they expect you to have to carry. Now that you're trying to license out this product and take it on your own, because they're going to ultimately want a piece of the pie if this becomes successful. So these typically become areas of negotiation, in that some of these licensing agreements are stock for all industries and not necessarily life sciences. So up front, they might be asking for product and completed operations coverage. Well, as I said earlier, this is purchased separately. And if you don't have a product, why buy the coverage? And so unfortunately, if you do buy it, then you're subject to insurance companies have minimum premiums. So you end up unnecessarily spending money. And as we know in startup land, cash is king at this point to move your product down the life cycle. Now, what I have seen in some instances is that startups will negotiate with the facility to, in exchange for some other provision within the contract that they want better terms. They might defer and buy the product completed operations coverage in lieu of getting some better terms someplace else. And so, we'll get involved and help them, understand that and say, here's the cost for this, and you should try to negotiate it out, and then they determine if it's up to them or makes sense, to negotiate that. Another area where you'll see required by contract is going to be something familiar to a lot of folks, and that's going to be around the purchase of capital equipment and or vehicle leases or finance agreements. And that's supposed to be or, not our. And so, here is where you would have, a bank is lending you money perhaps. And so in that instance, if you're buying capital equipment, lab equipment to do your R&D, they're gonna require you to carry property coverage. And they're gonna want to be a loss payee, which just means that as long as you have a loan with them, and that equipment is damaged or destroyed, that the check's gonna come in the dual name, so that they're in that process of replacing that piece of equipment. Also, you'll see within a vehicle lease or finance type agreement for purchase of a vehicle, again, the company wants to make sure that you're carrying, comprehensive and collision coverage. If you crash that vehicle before the loan is paid off or the lease is up, that, again, they're on the dual check to make sure that they're going to be made whole in that instance. There's some other scenarios later in the development of the company where required by contract becomes a situation where you have to purchase insurance, and we'll talk about that as we get a little deeper. But that's going to be around vendors and suppliers. You see it with perhaps a contract research organization, which is referred to as a CRO, and they typically help run clinical trials, or contract manufacturing organizations, which are outsourced manufacturers of your product as you go to market. So the next area we'll talk about is when required by law. Now, interestingly enough, Texas does not require workers' compensation insurance by law, but that is not the norm throughout the country. Most states, if you have an employee, W-2 employee, not a 1099 contractor, you are required by law to carry workers' comp. And then we will see, again, a lot of these contracts, particularly with landlords, if they know you have employees on site, they know that that's not covered on your commercial general liability. So they want you to carry workers' comp. And to be quite honest, as a small startup, the cost of workers' compensation is not that expensive. And so typically it's something that most companies, although not required, they typically still purchase that coverage. Business auto liability. So again, I mean, we all know to register your personal vehicle, you have to provide proof of insurance. And the same holds true if commercially you think it makes sense to buy a vehicle. A lot of startups don't buy vehicles, but sometimes they do. And if they do, then you have to have commercial auto liability, which will go hand in hand with the contractual liability we talked about around the lease or financing of a vehicle. This presentation, as I stated, it has been given throughout the country. So I do include this situation. In Texas, they don't have statutory disability requirements, but should you decide to grow and expand, particularly if you have employees in the state of California or the state of New York, they do have statutory disability policies that you have to buy for injury off the job. It's not a replacement of wages like workers' comp. I mean, it's not medical benefits like workers' comp has, but statutory disability provides some lost wages for injury off the job. Again, not a Texas thing, but happens in other states. Another area where you'll see be required by law is if you are going to be doing a complex clinical program to get your product approved, and you need to get patients in foreign countries. Unlike US FDA here, we do not have a requirement to carry clinical trials insurance. That is typically dictated by the site or the institution where you're conducting the trial. But if you're doing clinical trials overseas, and this is I have a whole nother webinar on foreign clinical trials that, so I'm not going to get too deep in the weeds here, but in essence, by jurisdiction. So if like you want to do a clinical trial in France, then you are required when you submit to the ethics committee there to also include an insurance certificate that meets their jurisdictional requirements. And I think it's something like $500,000 per patient, $6.5 million aggregate, and then they have a requirement for extended reporting period. So I'm not going to get too deep in the weeds there, but ultimately that becomes a consideration if you're looking at a complex global trial where we would have to analyze what countries you plan to do these trials in, and then we have to make sure that you are complying with their local laws so that you can even start a trial, because failure to procure the proper insurance in those countries can lead to trial delays. So next, so now you formed your entity, you've maybe got some non-dilutive cash, you've gone into an incubator or some kind of commercial real estate, and now we get to this investment requirement. And you still may be looking at non-dilutive areas of which you may get a grant, and there are grants, and again, this is geared more throughout the country, but there are grants that actually require you to carry certain levels of insurance to have the money released to you. And so certainly, NIH or SBIR doesn't have those requirements, but there's some state grant funds that do have these requirements, and even local, more on a local level. In some states I've come across where they send through their grant agreement and they say, I need all these coverages, and so we have to put it together for them. Another one is going to be your venture capital or private equity type money that you get in. And in these instances, this is where the nature of your company starts to change. It's no longer the founders per se. You're starting to get these outside investors coming onto the board. And when that happens and it starts to get more complex, this is when companies start looking to purchase directors and officers liability. Likely the venture capital group or the private equity group are going to place someone on your board, so they're going to mandate it of you. But this is the time when things start to become more complex. So directors and officers liability is designed to protect the decisions made by the board for potential third-party lawsuits due to what can be deemed wrongful acts. Fortunately, the risky nature of life science companies is that a lot of companies unfortunately do fail, and when that happens, the people that invested are looking for their money. And so bankruptcy, insolvency is a very real thing in the life science world, and a directors and officers policy can actually protect the individual directors and officers from such suits if this happens. And that's because that's an instance where the company itself doesn't have any assets at that point, so they can't indemnify the directors or officers as the bylaws state that they will do. And so the insurance steps in for what we call non-indemnifiable losses, the inability to indemnify and protect these directors and officers in that instance. And so that's where you'll see the purchase of a directors and officers policy. And it's also important to note that not all directors and officers policies are created equal. It's not like buying an auto insurance policy. There are some very good directors and officers policies, and there's some very bad directors and officers policies out there as far as what's covered and what's not. So a good look at the exclusions is always important. And so the two areas that we really like to focus in on is a product liability exclusion. Ideally, you don't want a product liability exclusion on there at all. Now, when you're in R&D, it's not as big a deal, but once you get in the clinic, that now is a product. It's a pre-commercialized product, but it's a product. And once you get on the market, that is also certainly a product at that point. And so, yeah, ideally, no product liability exclusion, but if it's on there, there's varying levels of language that have been problematic in the courts. And you really want, so certainly a directors and officers policy is not purchased to protect product liability. That is not the intent. If someone is using your device or taking your drug and they have an adverse reaction, that is not where a D&O policy comes in. However, some of the language has ensnared directors and officers where we really want a for language. So the exclusion is for product liability. So it makes it very clear that the policy is not going to cover these injuries. But what happens is some of these companies have this language arising out of, as a result of, this language becomes problematic because if it's somehow determined that perhaps there was some clinical data somewhere or there was some instance where the board maybe knew that there could have been an issue with this product in the marketplace, all of a sudden, when you get a lot of these product liability claims are dual claims. They're a claim against the product itself and then against the individual directors and officers. And if you have this based upon arising out of language, insurance companies don't do themselves justice, but they end up grabbing onto that language to exclude a claim. And so that can be very problematic. That based upon arising out of language is really something you need to look for versus the for language or ideally none at all. Another major exclusion we see on a lot of these policies are antitrust and unfair trade practices. And that, to be honest, is the bulk of lawsuits that come up in directors and officers liability protection. And the sources of these can be from competitors, suppliers, vendors, current and past employees, and even regulators. And so all you have to have is, a current or past employee claim that you unfairly took their idea or something like that. Even if you're under contract, once they file a claim, you have to defend it, whether it's legitimate or not. So it's actual or alleged. There can be an allegation, and defense costs can be quite costly. So these antitrust and unfair trade practice exclusions are not a good thing to have on your policy as well, but they end up getting thrown on. They're basically insurance companies throw them on there unless the broker asks to take them off. So you have to, or perhaps after you've gone through listening to this presentation, to look at it and say, hey, I don't want this on there. This is, I was told this is going to be problematic as a possibility. And so that's that's a discussion on D&O insurance. Also, companies, particularly more so in the pharma space, may look to go public, and public is a whole different world as well. And again, I have another webinar completely dedicated to public company directors and officers liability. But these are very litigious for the life science space, particularly around initial public offerings and/or reverse mergers. But companies have to weigh that. Hey, if you're developing a drug and it's going to cost you, close to $1 billion, I mean, the best way to get this cash in is to go public and catch the eye of folks. And you're getting outside funding as well, but you're out there in the public. And so, believe it or not, in 2018, 46% of all class action lawsuits were related to merger objections, and a little over 10% of all lawsuits were in the life science codes for public companies, which is a high number for one industry for sure. And so that one other thing within the investment requirements that you'll see beyond directors and officers, and you'll see the other policies that I've mentioned, they'll want to scrutinize and make sure that you do have commercial general liability and property and auto and comp and so on. But D&O is the newly introduced product, directors and officers liability. And also key person life insurance is typically a common ask for the key people that are involved in this transaction. So you're talking typically the CEO and maybe the CSO, CMO. Some of these key folks are asked to purchase life insurance that's owned by the company. And this can be tricky because for life science companies, you're not generating any revenue. So the insurance company is looking at you like, well, what's the insurable interest here? You want to put up $3 million on these guys or $5 million, and you're running a negative, negative revenue, obviously, at this point, because you're just developing. So those become very tricky, and you have to, look at the balance sheet, and you have to look at the percentage of ownership, and you have to look at actually leverage, hopefully, some of the personal net worth of that individual and what their salary is. So you have to look at a whole host of factors, even the employment agreements, because the employment agreement might say, well, we're going to pay this guy, 125 grand, but his package is actually 200K because we're giving him 75,000 in options each year. And you can actually use that 200,000 number in this formula. There's a formula that these insurance companies will put together, but it's not necessarily an easy process. So, some have come to me and said, well, I'm getting financed and they want 3 million. So let's go get 3 million. Well, I wish it was that easy, trust me, but we have to look at these various factors to make sure that the insurance company will get comfortable. And sometimes you have to, get creative and use a couple different companies. Sometimes you have to buy personal insurance and then transfer it over to commercial. You have to do some things that just aren't normal in, purchasing key person life insurance for a company that's generating 10 million in revenue a year. It's a lot easier to understand on that piece. Okay, so the next area, so now you're funded, hopefully, and there's some catastrophic type risk areas that we look at. We look to provide protection. So research and development property. So an example of this would be, you get $135 genetically modified mouse from Charles River, and you're doing work on it over the course of 6 months, and all of a sudden that mouse could be $250,000, right? So traditional insurance, if you just bought a traditional insurance policy and that mouse burned up in a fire, you would get $135. Well, that's obviously not, going to help you out or do any good. So in the life science world, you can actually purchase scientific animal coverage. You can purchase research and development property, and every company does it a little differently. So you have to, be careful and watch the definitions of that. But in essence, it gives you the cost of the original mouse plus the cost to recreate that mouse as well. Obviously, you can't make up for lost time, but if you can get money back to help you get back to where you were, and that's where insurance can come into play. And you can actually, within the same vein for research and development property, you can purchase business interruption coverage, even though in the traditional sense, again, you don't have income coming in. Like, it's real easy to determine if you're a shoe store and you have a fire, and last year your net income was $1 million, then that's what the business interruption is moving forward, why you rebuild. Well, it's not as cut and dry in life sciences. And so the way you can purchase business interruption coverage in the life science world is through missed milestones, recertification of FDA. So if you were working towards a milestone and you were going to hit that milestone based on where you were, and this, damage to your research derails that, you can actually purchase the coverage for that next missed milestone. And again, it's complex, to underwrite that piece as far as paying out the claim, but that is an available and specialty coverage on the property side. Some companies, as they're in the R&D world, will use some services. They'll do research conducted for others as a way to generate some revenue while they work on, their actual product. And so when that happens, this introduces a new exposure of professional liability or errors and omissions. When you're doing research for others or offering professional services for others, your customer is not going to have a bodily injury or property damage from you writing reports and providing services to them, but they could have a financial loss if they rely upon your work. And so that's where professional liability and or errors and omissions comes into play for these professional services. This is also where you will see contracts come into play. You might develop your own master service agreement, whereas there are some provisions that, typically I would help you or the insurance company would help you make sure that they're in there, items such as limitation of liability, so that if the contract is worth $100,000, they can't come and sue you for $1 million. They can only sue you for the size of the contract. That's one area that we look at. Sometimes you may also be forced to sign your customer's agreement. And so we have to look at that and review that to make sure you're not agreeing to something that may put you in danger. And if it's something, sometimes you have to kind of pay to play. Hey, you're trying to generate this revenue, you're trying to move your product along. But sometimes you might have to agree to stuff that you might not be so excited about. As long as we know about it and understand it, and if there isn't a limitation of liability and you could be sued for a couple million, then we have to look to make sure that we're purchasing proper limits to protect you. Another big area is protected health information, or this is commonly referred to as data breach or cyber liability. Again, I have a whole nother webinar on cyber liability. Very complex. It's not a one-size-fits-all policy, but companies again that are developing a product, particularly in the clinical stage, you start to have protected health records, and so there's policies that you can buy bare minimum, or you can buy the world for these cyber policies, and they typically have two sides to them. They have what they call first-party coverage, which protects you as the company, and they have third-party coverage. So the first-party coverage is going to cover things like notification costs. So if you have a breach, 48 of the 51 jurisdictions all have, I think it's 49, all have some kind of breach notification law where you have to, send them the notification, and you have to provide credit monitoring for 12 months, 24 months. I'm sure, anyone in this room or on this webinar has received that letter in the mail. We may have had a data breach. It might be from the electric company, or maybe if you were ensnared in the Target data breach, or any number of these data breaches where they're providing you with credit monitoring. You can buy insurance protection for that, to the cost to notify and the cost to provide the monitoring. Provides public relation costs, which can be a big deal, to let folks know, hey, this happened, but here's what we're doing about it. Here's how it happened. We understand it. We're taking these measures, and we weren't reckless with your data, and so on. It can provide business interruption coverage in this instance as well. So, if you have this data breach, it's going to derail your operations. You can purchase business continuity coverage in that regard. It provides loss of data coverage on a first-party basis. Cost to hire a forensics team and a team to kind of recreate this data. It can cover, you can purchase fines and penalties if you have to pay various fines and penalties in states or federally as a result of this data breach. And then there's also another first-party coverage I'll mention. You'll see like ransomware. This happens more in large institutions or government agencies, where a company will come in, or you'll have a hacker, typically maybe a foreign nation, comes in, holds the data for ransom, and says, we're going to release this out, into the internet, unless you pay us X amount of dollars, and if you do, then we'll release your data. It becomes a slippery slope, and so, but there's coverage for even those scenarios. And then there's the third-party coverage. So you have all these folks that had their data breached, and when that happens, certainly in the protected health space, there's been instances where people file a bunch of claims against health insurance companies, and they get these checks cut out fraudulently. Well, then the insurance company figures it out, and then they go back to the person whose data was breached to try to recoup that, and then that's when they'll come to you. So that's where the third party. And then human clinical trials is another area, and we talked a little about that foreignly, but here in the U.S., even if you're not going, even if you don't have, say, a pharmaceutical product or a medical device that's going PMA, you might still be doing pilots at various institutions. And those institutions, even to do a pilot study, because you're testing on humans, they're going to require you to carry some kind of clinical trials policy. So again, this would be a contractual type of situation, but you'd have the institution, the site, the IRB that may be saying that you have to carry this amount of coverage, even if you want to conduct your pilot study. And certainly if you're going, pre-market approval for medical device, or you've filed an IND for pharmaceutical, if you're going to these sites and facilities, they're going to require you to carry clinical trials liability coverage. Okay, I know we're bumping up against some time, so I'm going to speed this up a little bit here. So, we've been just going down the chain of development. So now, hopefully you're getting to a point where you are now going commercial. And so the human clinical trials, if you did conduct clinical trials, was a product liability policy, but it was for pre-commercialized product. Well, now you're going to have a product on the market. A lot of people think of product liability as just strictly the bodily injury related to the product, but there's really a whole lot of other areas that could lead to a product liability claim beyond the physical product. It could be the training and instructions around it. It could be the labeling. It could be the shipping and packaging. Something happens there. It could be in your advertising, service manuals, warranties, owner's manuals. There's a whole host of areas that people don't think about beyond just the product itself that actually lead to a product liability claim if those items aren't scrutinized. Another area that companies will look to buy coverage is for product recall. Hopefully, you don't ever have a class 1 recall. That's the highest level from FDA, and typically means that you've had some serious adverse events and/or deaths, and so you can purchase coverage for class 1 recalls. You can purchase coverage for just voluntary recalls. You can even purchase coverage for mitigation costs if you notice that maybe there is a one-off, but you want to be pretty cautious. Go out there and try to nip this thing. You can purchase coverage around that. Supply chain disruption, that can be a big area that companies need to look at. You see this heavily in the pharma space where you might have a specialty formulation that there's only 1 or 2 suppliers in the world that say can do this for you. Well, what happens if that vendor has a major property loss and they have the inability for you to fill orders for you? Well, now you're actually losing income as well. So there's a coverage called contingent business interruption that you can look to purchase for these areas. And there's ways to also risk mitigate this by way of trying to identify backups and how long it might take to get someone else up to speed. And so, I mean, it's the most disruptive typically in pharma, but that's not to say, again, I mean, if you're relying on someone for your device to build out a very specialty electronic component and they have some disruption, this coverage is something to look at and also have backups as a possibility. Certainly within supply chain too, we look at the liability issues. We really want to make sure that you are only responsible for what you should be responsible for. So if there's some kind of manufacturing defect, and again, we address these contractually to make sure that, what actually caused the bodily injury if something happens related to your product. Was it your actual product itself, or did the contract manufacturer do something improperly that led to that claim? Another one that is very specialized and not purchased often, there's IP infringement coverage out there, very expensive. There's 2 kinds. There's defense, where if someone's claiming you've infringed on their IP, or there's abatement where you can actually go on the offensive. The main reason that anyone even looks at this is related to kind of the deep pockets theory. So if you have a super disruptive product where there's a major player in the market that say has greater than 50% of the market share and a excess of $1 billion, in revenue, if they see you coming, they're likely to just file a claim against you and say, hey, we've got this big bank account and you've got maybe a couple million if you're lucky in the bank. So let's do battle. And so some companies have used that to level the playing field and say, hey, I've got a $2 million, $3 million IP policy. We can go all the way to Supreme Court with this. So let's go. Let's do this. So again, rare, has to be the right scenario for this. Again, we really have to talk it through to make sure it makes sense for that kind of spend. And then we'll end here. This is the final topic. For the most part, every entrepreneur is in this to ultimately make an exit at some point. And so it is important to be proactive around some of your insurance purchases. And so, so just these 3 products up here, just to give you an idea, is that all of these policies are written on what we call a claims-made basis. And so standard insurance, again, going back to say a retail operation, typically is purchased on an occurrence basis. So that means that if you say bought the shoe last week, and then you somehow it leads to a rash or some irritation, and you end up suing. It's when you actually purchased the shoe and when the irritation happened. The occurrence of that injury is the policy that responds. Where in a claims made policy, particularly say like in a device or pharma, is that you see this a lot in clinical trials. They could have been in the clinic 3 years ago and are just starting to realize residual effects later. Well, that's going to be when the claim is actually made. It's not the policy that you had in force 3 years ago, but the policy when the claim was made is the policy that ends up responding. And so a lot of times when a company is doing their due diligence to purchase you, to acquire you, is they want to look at these because they don't want to get ensnared in some claim 3 years later for something that happened that should have been on your watch. So they're really concerned about these extended reporting period, which in essence is also called tail coverage. So if you're acquired, you likely would, stop buying product liability, but you would purchase this extended reporting period so that if anything came up 2-3 years later, the acquirer doesn't have to worry about some surprise that comes up. And so again, not all extended reporting periods are created equally. And so a lot of times you really want to look at these provisions. The really good companies will have predetermined tail pricing built right into their coverage form. So they'll tell you, if you want 3 years, it's 100% of premium. If you want 5 years, it's 175. If you want 6 years, it's X amount. It's 200% of your premium. So that that, because there's other provisions that will say, at the time of the cancellation, we will determine the price. Well, that's not a good position to be in for you, particularly if you have to buy this coverage someday. And so that's something that we try to look at, these predetermined tail or extended reporting period provisions. Another thing we have to look at too is minors. If you have minors involved in taking your product or using your product, that a lot of states have age of majority plus 3 years for when they can file a suit. Well, age of majority varies by state even. In some states it's 18, some it's 21. So if you have a pediatric using your device at age 12, in theory, age of majority could be 9 years plus another 3. You could have 12-year extension of a possible claim for when they use that device. And so that's another area where you have to look at that. Some companies will only offer max 3 years. Some will only offer max 5. Some offer 8 years. Some offer unlimited. So, I mean, these are things that you kind of need to keep in mind. And it actually shows to an acquirer that you've thought through this stuff. It actually, can make you a more attractive target that you've thought through this stuff. And then the same holds true if you were in errors and omissions. The two big areas are the product liability and the directors and officers liability, where these acquirers don't want to see that. And certainly if you are a heavy services firm, that's where the errors and omissions come into play. But it's the same concept for all three as far as looking at these predetermined extended reporting periods and what kind of time period you might need. So with that, I think we've got about 10 minutes, so I will wrap it up. I hope you found that informative, and I'm happy to take any questions that you might have at this point.
I'm interested in that tail coverage. Would the buying company wouldn't that just go under their insurance, or like what's the difference between?
It really depends. So, I mean, a lot of times, they don't want to take on some of the past liabilities, particularly, if they know that maybe you struggled early on. So it really depends. It's not a one size fits all, but best practices is to anticipate that and at least know that if they're not going to buy all your previous liabilities and they want you to have this coverage, that you have the ability to buy it. And it's nice to know the predetermined cost versus we'll charge you whatever we feel like charging.
Yeah.
Sometimes they could say it's 500%, and you're like, oh my goodness, that's crazy.
More insurance out there than I thought there was.
Well, as I said in the beginning, when I first started going to a lot of these events, people are looking at me, what's the big deal? It's just insurance. But, that's why I try to do this crash course, just to say, here, this is what exists out there. There really is a lot to consider and think about. And, you heard me mention at least 3 or 4 times that I actually have full other webinars or sessions that I give on some of these topics that can go a whole lot deeper than what I went into over the course of this.
Are there specific events where a small startup company should go and talk to someone like you because you just don't know what we don't know?
Yeah. Well, I always prefer to get in as early as possible because it's nice to start it right. And then, I tend to be super proactive in that. I kind of prepare you and say, hey, look, kind of almost like we did here. You're going to have this come up, 2-3 years down the line. You should be thinking about this. You should be budgeting for this. You should, write this into your funding proposal. That this is coming. That they might ask you for $2 million in directors and officers, and it might be 12 grand. Good stuff to know, at that time. So, I always say the earlier the better, but I come in at all stages of development. I have companies that are, brand new, first time buying insurance, and I have, commercialized companies that are doing, 50 million on the market. And some of those companies that are commercialized, I've come in when they were already commercialized. So there's not like a exact time, but I like earlier to clean up the mess if need be, and help a company anticipate forward, so that you don't get this. You're so excited you got this pilot study in an institution, and they want you to buy $5 million in insurance, and now that's another $20K that you wasn't even on your radar that you were going to have to pay another $20K for this insurance. So that's why I prefer early, just to kind of help you think about this.
And off the top of your head, do you know any of the grants here in Texas that require coverage?
That I don't. I've been in Texas for 16 months, so a lot of the stuff is from the Northeast, where they have like Mass Challenge. If you win Mass Challenge in Boston, they have requirements. There's some stuff in New York as well, that if you get New York specific grants, they want you to have the coverage. I don't know, my biggest exposure to grants, here's the secret, the cancer prevention stuff, and they don't actually write in a requirement for that. So I haven't had it come up yet.
I guess I have a question. So, Ryan, tomorrow you wake up, you say, I don't want to work with Galiot Insurance anymore. I want to start a life science company. What's the first 3 policies you do? 2 or 3?
Well, it'd be operationally specific. I have a different view in that I tell people, it sounds crazy, but don't buy insurance that you need it when you're young. So, once you start actually having exposures, like if you're doing R&D work and you purchase equipment and you have a lease, well, then you should buy a commercial package policy, and you should, look at what the value of your equipment is and what the value of your, animals are. But if I started a company tomorrow and I was going to, work out of my house or in my garage tinkering, and it was just me and maybe a buddy, maybe not a lot of insurance guys would say this, but I wouldn't buy any coverage yet. There's not a ton of exposure. So that's exactly what yes, and that's what a lot of guys do, and I'm actually good with that, because who knows, you might in 2 months skip this. I'm changing. But once you get, that's why I have this list of 6. Once you get the contractual requirement, or once you start hiring employees, these are times where, okay, you're no longer you in the garage anymore. Now you're starting to be a company, and that's when you start looking at it. But there might be some other of my counterparts that would say differently, but I'm all about be a lean startup, bootstrap, do what you need to do. Don't be reckless either, but when you need it, okay, let's start buying it then. But yeah, let's look at this. What is it?
I guess I have one other question. Yeah. So that IP insurance is kind of interesting. You said it was expensive.
It is expensive, yeah.
What is expensive?
Like a defense policy might start at $50K per million a year.
And that's all kind of based on what revenues or potential revenues.
It's based
higher than.
Well, it's really, it's heavily underwritten. It's really based on what your product is, what market are you disrupting, who's the potential person on the other side.
Apple versus
is it Merck or is it who is it? So it could be 30 grand, but I'm just kind of giving you. It's still a rough number per year. But again, if it makes sense, I have an example where again I have a customer that is disrupting a player that has 70% market share and 10 billion in revenue. They bought a $3 million policy for $130K a year because it made sense to do that because their product is way back. It wasn't even close, and they had the foresight to think about it. You got to think about it way before, too. And so, that's when I like going back to when is the best time. Well, if I get in early, that's kind of when I'm scoping out your company and asking you, who's your 3 largest competitors? That's a question I ask. People are like, why are you asking that? I just want to know what that looks like down the line, because the earlier you buy it, these are claims made policies as well. So the earlier you buy it, the better it's going to be for you, if it makes sense, and if you have the cash.
Is there any situation, I would never say intentionally do this, but where you could accidentally commit insurance fraud?
Accidentally. I don't know about accident. I'm not sure.
Yeah.
That's a tough one. I just think about it. Yeah.
Since it's like claim basis, like, oh, one of our pieces of equipment broke and we didn't know, so we got insurance and then we called up and said it broke and they fixed it. But they didn't know when it broke, but we did, and we just thought we could do it.
Yeah, typically,
that could be an accident. I was just wondering.
Yeah, no, typically it's like, typically if the house is on fire, you can't hire coverage.
Yeah.
So, the only instance where that happens in insurance right now is, pre-existing conditions. You can now, under, Affordable Care Act, you could not have bought insurance for 10 years, develop cancer, and then you can go buy insurance, and the insurance company has to pay $1 million for your chemo treatments. That is the only scenario in the insurance industry where you see that, where typically you can't, be like, well, yep, I broke my equipment, or my equipment broke. Let's go bind a $100,000 policy and collect it the next day.
Okay, I was wondering if there's any other weird situations, just in case.
Yeah, no. Typically not. And again, that's where, I would get heavily involved. You think you have a claim, talk about it. I'll tell you what your options are. Sometimes we have to look at the deductible question. Does it make sense? We've got a $2,500 deductible and it's a $3,000 loss. Is it worth it? Probably not. But if it's 10 grand, let's do it,
Cool. Well, I think we're right on time, so we'll go ahead and wrap it up. But I know this is just an insurance 101 crash course. So if anyone has any other questions for Brian, his contact info is included on the last slide, which is fun. They can download it too. So there we go. Cool. So yeah, feel free to reach out if you have any additional questions. But otherwise, thanks everyone for joining, and thank you, Brian.